Well, good morning, everybody. My name is Michael Burke, and welcome to Develop Your Edge with Anthony Crudele. It's Thursday, April 27th. I'm standing in for Tom Schneider. Tom is in New York this week, hobnobbing with fellow wizards at the Market Technicians event. So, Anthony, it's great to see you. It's been a while since you and I have done something like this. I also miss our live in-person events. That is really your element, those live presentations. Hopefully we can figure out a way to do those kinds of things again.
No, absolutely, Mike. It's great to be with you. You and I have a long history together. I think we've done a bunch of live stuff. This is the first time I think you and I. No, we've definitely done webinars before. It's just been some time, and it's great to be back with you today.
Great. It's great to see you. Before we get started, please keep in mind that the following presentation is for educational purposes only. All of the symbols and ideas discussed are for educational purposes and should not be considered recommendations. Real-time trades that are placed during some of these presentations are simulated using the NinjaTrader platform. Futures trading is not suitable for everyone. If you're going to trade futures, you should be trading with risk capital. A good definition of risk capital is capital that you can afford to lose that will not affect your lifestyle or your retirement horizon. You should always have a risk management plan in place, which may include utilizing micro futures contracts, and when appropriate, make sure that you do not max out those day trading margins. Futures carry a high degree of risk. You could lose all of your money, more than the initial margin, and the opinion of our guests are not necessarily the opinion of NinjaTrader. So, Anthony, I think the topic today is super relevant for traders, right? There are so many moving elements that drive the market. That market environment is something that traders need to pay close attention to.
Yes, and I look at it like this. You have outside influences that impact your strategy, and then you have what's going on in your strategy and how the market is reacting to your indicators. Outside influences are what we're seeing right now. We've got earnings. We've got what's going to happen with the Fed. We've got beginning of the month, end of the month. Those are important because those days are different than the other days because of flows that are coming into the S&P 500. We're talking specifically for S&P, NASDAQ, Russell, Dow. They are definitely impacted on those days. And I think right now with earnings, it's really a time where you have a lot of push and pull, right? You have all of these stocks coming out, these big stocks coming out with earnings. You saw the other day with Meta, how strong that was. You've seen Tesla just kind of fall off. And all of that is a push and pull within the indexes. And so you have the stocks that are within the S&P potentially doing something that the S&P maybe isn't keeping up with, or you have a divergence. And there's ways to go and find that those types of things. But for us as traders that maybe don't look at all of these different stocks or look at all of these different things that are happening, such as the Fed Watch tool, which I'm actually going to pull up later in the show today to see what's going to happen with the Fed, it's important to still put in something into your strategy to where you can identify what type of environment this is. You'll hear myself and many other traders on Twitter talk about you have to find the times to when the environment really suits your style and strategy, because that's the time where you're going to take most advantage of the market and most advantage of your strategy. When the times in the environment do not support your strategy, meaning that you're like, wow, it just yesterday it hit my level and it stopped right here and it was perfect. Then the next day I did the same exact trade and boy, it didn't work out. Well, a lot of times you have to go beyond what's happening in the strategy to see what's happening in the market. Was it a day-to-day? Was it a news event? Was it the end of the month? Was it the beginning of the month? Is it earnings? Was that one single stock moving the market? And those types of things are so important because that's how you get a true representation of how your strategy is. And although I can't go over every single part of what's outside impacting your strategy, the outside influences, today I want to use just really two simple tools that I use to help me identify what kind of market it is. And, I'll go over ways that I think that you can overlay this on your strategy and the traders out there to help you become a better executor and understanding of your environment.
Yeah, I completely agree. The thing that you touched on there, I think, is one of the the skill sets that traders really need to master, and that's patience, waiting for the market environment to match the way that you trade. A lot of times people try to force their trading. They want to trade, they want to get in the game, they want to get into a trade, and they're not patient. And having an understanding of the market environment and how that market environment is good for the way that you trade, I think that's very important.
Yeah, most traders focus on outcomes versus focusing on the process. Most people get into trading because they want to make money. Most people get into a trade because they just want a result, right? And most of them are not looking outside of what's happening on their strategy, because at that time they just get so hyper-focused on the outcome and on just getting into the market that they're not recognizing what's happening outside of the market. And a lot of times there are things that are happening outside of just the regular price action in the market that have an influence and can sway the environment one way or another. And I think that although you're never going to be perfect in identifying what the outside influences are, because some of these things are either over my head, right? What's happening in the macro environment? Do I really understand what happened with CPI today? Does that earnings really impact the S&P that much that happened in Meta or NASDAQ? And so I think that it's important to have something in place technically that at least gives you some edge. This is develop your edge to where you could identify, look at, is the market going to be choppy? Is it going to potentially be a trend day? What are we seeing in the responses off of my indicators to help me identify and analyze the environment?
You know, you touched on an interesting point there. One of the problems that traders face is that there are so many of those outside influences, and you get so many mixed signals. You know, how do you really read that? And the way to read that is to look at the charts and see what the charts are telling you.
Yeah, exactly. Maybe we go to the charts now and start here. And Mike, you make a great point, is that, you know, at the end of the day, it all matters. The only thing that matters is the reaction, right? The price action will still tell us what it thinks about the news. I don't have to know what the news is per se, as much as I need to know what the market's reaction to the news is. You know, this morning we had some data come out and the market right now is rallying. Do you agree with the market rallying based off that data? That doesn't really matter. Some macro people might say, I can't believe we're rallying. This is bad news, or, you know, is bad news good news? Nobody really even knows anymore, right, Mike? It's hard to know if good news is bad news or if bad news is good news. But understanding that, and I think that the point that you and I are both making is that the difference between somebody who just executes a strategy and actually somebody who is a trader understands that there's outside influences in their environment. And they have to be able to then take that understanding, and not necessarily understanding the depths and every single aspect of what's happening, because we're not going to be maybe, you know, macro people, but we do understand that it is having an influence. And so when we look at the charts right now, I'm going to give everybody two indicators that I think are extremely helpful in understanding what's happening in the current environment. Number one is Bollinger Bands. Number two is a Fibonacci retracement. The Bollinger Bands, I just want to make sure everybody knows and understands, I do not use the middle Bollinger Band for this. I don't need it. That's not what I'm using the Bollinger Bands for. I'm also using a 20-period, 3 standard deviation. I'll click on that just to show you. 20-period, 3 standard deviation. I wanted to calculate on each tick, and I just like using red. You know, I like things color-coded. The Fibonacci retracements, obviously you have the 100 and 0 because that's your 2 marking points. Then I have 70, 50, and 30. And I draw, I have them color-coded to where the red line could sometimes even be the 30%, depends on where you draw it, from the bottom or the top. But I have the resistance at red, the higher number, the middle in yellow is neutral, and the bottom one is blue as support. And I just do that because, once again, I like to have things color-coded. I'm not using also traditional Fibonacci numbers. I'm using 70, 50, 30. And I do that because I just want to see a breakdown of the market in this way. And I'll explain why in a little bit more detail here in a second. But those are the basic tools that I'm using. You actually can hit the F8 key on your NinjaTrader platform, and that will allow you to draw from one place to the next. which is pretty handy when you're looking at this. I should also mention that I'm using a 60-minute chart. And of course, because you guys know that I love my auto-anchored VWAP to the beginning of each regular trading hour session, I have that in there as well as we start to look down at today's action and we kind of talk about what's happening there. So first thing, 60-minute chart is my number one chart to look at market environment. This to me is perfect for day traders. And I know some of you may say, well, that's not really short enough term for me. And some of you might say that are a little bit longer term traders and say, well, that's too short term for me. How's it helping me with environment? And the reason why the 60-minute has always worked very well for me is because it breaks it down into, it really looks at the regular trading sessions with the transitions of the overnights. And it gives me just enough information to see how the market price action is acting. Are we expanding or are we contracting? And it gives me a very good kind of middle time frame point of what the markets are doing. So when I'm analyzing environment, 60-minute is my number one time frame. And what I do is I take the Bollinger Bands, and here we are just going back. I only have a couple of days on here. What I look for is this. The minute that the Bollinger Band makes a high peak or a low peak, I take my Fibonacci tool and I draw it. And if you go back and look at this point right here, okay, this is the point where I started to draw the line because the peak on the high side was made and the bottom peak was made. It started to get flat. So what I like to see is when the Bollinger Bands stop expanding, I now have an understanding that this move lower right here is now most likely at least stalled or stopped. Okay, you don't know if it's stopped or stalled because you don't know what the next move is going to be. It's not a predictor. It's something that's showing me the possibility of mean reversion and the possibility that the market is going to potentially stall in this direction. So you have this down move from the other day, then the Bollinger Bands close up. Now this 30% line, and I've actually done a lot of back testing on this. I created this really over 20 years ago. What it tells me is that when the 30% line is a great pivot of where we are relative to the high and low of the peak of the Bollinger Band. And what that tells me is that if we stay above this 30% line, which you see it try to for a good period of time, if it fails to stay above it, it then tells me that we're back in the possibility of expansion. Back here, we were expanding the range. Here we started to consolidate, potentially mean reversion, but if it can't hold it, we start to potentially expand again. So when we're analyzing an environment, I have up right here right now the E-mini S&P. We had a market that pulled back in a bull market. You can call it a bear market on the big picture. I don't care if this year is relatively a bull market. And you have the market on the 60-minute show you that it cannot withstand above the 30% line. And then the market starts to trail on its way back down. So what it tells me is when I look at this in the market environment, I say, okay, when we cannot get back above the 30%, I look at almost only shorting the market, and I look for accelerations to the downside when we're below the auto-anchored VWAP from the beginning of the session. So it's really clear to me that once we violate this, and look, you could see here a few times, the market got below the auto-anchored VWAP, bang, ripped lower. Got back above it, tried to rally, get above the 30% line, got below the auto-anchored VWAP, bang, expanded. And it tells me, and when you're looking at an environment, intraday, you might be getting some buy signals. And when you see where we are on that 60-minute, it's currently telling us that on these hour by hour basis, it can't even get back up on a mean reversion on that medium term. And so this is why I like the 60-minute, because it helps me narrow down in the shorter term to understand where we currently are. And so, Mike, maybe I bring you back in here and we talk about how I've layered some of these indicators to just really give me an idea of what the current environment is, the now, not the bigger picture, but what we are today.
Yeah, so what I really like about this approach is that you're not using standard Fibonacci numbers. One of the things traders often get into a kind of a rut is that they think that it has to be so exact. I have to use the exact Fibonacci number, or I have to use the exact number of bars or lengths. And the thing is that This is a game of rounding more than it is exactness. And I think using those 70 and 30 and 50 levels, that makes perfect sense to me.
So now what I want to do is let's take it here, Mike. And what I'm going to do is I'm going to click on this fib and I'm going to move it to today's action. And I'm going to take it from there. And then I'm going to go to the bottom one and I'm going to move that and I'm going to box this out again. And this gets really interesting to me because what happens is I always want to be in the now, right? I always want to be in the now. And when I'm looking at my 60-minute levels, which is, let me put that to be more exact. Okay, it's right on it. Now what we have is the Bollinger Bands expanded outside of that previous range, right? That peak got taken out on the bottom. And the only time I move this Fibonacci tool is when the bottom Bollinger or the top Bollinger Band, doesn't need to be both, one side needs to be violated, right? So if I just go here and I click my F6 and I draw a horizontal line, you could see it was violated there. So then now we have new Bollinger Band peaks. So what I want to see is every time that the Bollinger Bands are starting to contract and they make those peaks, I can understand if there's a possibility of mean reversion. Now, just to go back and explain that if there is no peaks and we're outside of these peaks and the mouth of that Bollinger Band remains open, then that means that we're probably going to continue to go in that direction and Bollinger Bands are going to continue to expand, meaning that move could continue to happen. But once the Bollinger Bands start to come back in, now I have an idea of, is this just a slowdown or a mean reversion? And it goes back to the 30% line. Here we are. So yesterday we closed, market closed weak. Overnight, we stabilized above the 30%. I come in on a day like today, then I look at my 50% line. And this is that barrier of like, okay, did we just get just enough back of mean reversion to stop at the 50%, which it did several times. But ultimately, if we start to push and hold above it, this goes beyond mean reversion. It could tell us and indicate that this low is potentially a good one. And then we look to start to test that upper boundaries. And maybe we go to push up towards that 70% or even that 100% of that peak. So what it looks at is this just a mean reversion move to end up going back down? Are we going to continue to trend lower? Or if we violate the 50% line and we start to cross over it, are we now switching and saying, now we're looking at a rally that has legs to continue to push higher, and this is maybe a little bit more than just mean reversion. We could go back into what that longer term trend has been on the daily with the S&P. And so that's why I look at it from this perspective. Most of you know that when you look at a Bollinger Band, you look at that 50% level and you're always like, well, that's kind of like that pivot, right? Can it just get people look at the half gap? People look at 50% a lot and say, you break it down and say, can the market hold above that level? And you say, okay, now we might start pushing up towards resistance. I'm looking at this, but not based upon price action, but based upon the volatility of the market, because the Bollinger Band tests the outer limits. What that means is that when the market's going up or down, that Bollinger Band is saying, look, we're trying to get 2 or 3 standard deviation. In my case, with my charts, it's 3 standard deviation away from that mean, which is just a 20 period moving average in the middle of the Bollinger Band. So it's saying to you that this market could, if it's going to have a 3 standard deviation move, this is how far it could go. But once that 3 standard deviation move stops and it starts to come back towards that mean, then you have an idea that the market is stalling and no longer trying to expand. And Mike, you know Bollinger Bands as well as anybody I know. And I think maybe we talked a little bit with you about my reasoning for doing this versus doing this over price.
Yeah, I think this is such a unique approach. Most traders are looking at these kinds of Fibonacci levels on the price, but to apply it to Bollinger Bands, I think is a brilliant idea. Let me ask you this question. So right now, if you're looking at the chart, the market is moving up. We're in a setup that I think that you would agree could be either a breakout or it could retrace from here. So how do you view where we are right now, and what would be your setup and trigger for a trade here?
So what I look at this current point is you have a crossover of the 50% and you're holding above the VWAP for the day. The top Bollinger Band and the bottom Bollinger Band are opening like a mouth and expanding. So in this current situation, even though you have a 70%, which comes in at around 41.14 is what I would consider resistance, I still only look to the buy side on the intraday, because the reason why the VWAP comes into play here is because if I auto anchor it to the open of the day and we're above it, and the Bollinger Bands once again are trying to say, look it, we are expanding here, and we are saying that this 3 standard deviation just keeps going the possibility of higher and higher. So the longs right now have the ball, they have the control. The only thing the 70% line does for me is potentially either a cover scenario or a lighten up on my position. But I look for the pullback to the VWAP now, and I say, look it, can it sustain trade above it? Can we continue to build on this momentum, volume weighted average price from today? Can we hold above that to continue to try and push to get up into this higher, really this next area, which is the top 30% of that volatility? Because if it does start to hold above 41.15, 41.14, it now puts what I call unfinished business into play. And what that means is that markets like to try and get to a 3 standard deviation move. The S&P, you don't see it happen often, but it does try and get there. So what I mean by that is that when the market tries to push lower, and then ultimately it stops, and that 3 standard deviation move gets drawn to the bottom and the top of the peaks, that market likes to push those limits. So if it fails to get further lower, then it might go back up and test the previous peak. And so that to me is like the pressure point. Above 41.15, you can see a possibility of 41.37. And so I want to be on the side of where the momentum is. We're talking today about analyzing the market environment. Look at how different we were just from yesterday and the day before, where we were trying to stay below the 30% and they kept pushing it lower. We couldn't even get to the 50%. Now you're back above that. And you have to recognize that for today, the price action is trying to push the higher limits, because everything is pointing to the possibility of expansion of range, not reduction of range.
Yeah, I agree. It's interesting. If you look at this chart, the slope of Bollinger Bands is something that I look at, and we are making, we're kind of in a down slope if you look at the Bollinger Bands overall. But now we've kind of started to go sideways, and I think that with the bands opening as well is an opportunity for expansion in range here for the day, and I think this shows that very clearly.
And let's go to another market, because this is something that I think is extremely important. Okay, is that what's the upside leader, everybody, in the market? It's NASDAQ. What's the number one stock right now that everyone's watching today? Let's talk about analyzing environment again. Meta, right? And so I can't see what Meta is doing right now, but I'm going to look to the NASDAQ. Look at what the NASDAQ is doing. And the NASDAQ is your upside leader. And so if the upside leader is outperforming on a day that we're going up, right? Overall, the NASDAQ is the stronger market this year. You do not want to step in and short the S&P at resistance when the upside leader is pushing through resistance. So when you compare where the S&P is to the NASDAQ, you don't have divergence. And I've talked about divergence a lot on this show, where you have one market possibly up or one market possibly down, one market's at support, another market's at resistance. You maybe buy the weak one or sell the strong one, and you try to look for that divergence to maybe sort itself out. But when you have the markets working together and the upside leader is pulling everybody up, you definitely don't want to step in and fade the one that's weaker, because right now they're reacting to the strength. And look at what's happening here. This is the situation that has the possibility to happen in the S&P. You look at the NASDAQ, and I drew the fibs here. Look at the 30%. The minute it got above it, bang, it got to 50% extremely quickly. Retested the 30%, only 1 or 2 hourly bar closes below it, and then quickly regained it, and then bang, back to 50%. Starts to sustain trade above it, and then bang, it rips up again. And so it's showing you in this environment that the NASDAQ shorts really have a weak hand. And the minute that the market looks bullish, it reacts very quickly. And so when you have them push above the 70%, do you see how this move really kind of accelerated here? This is something I've seen a lot. And the NASDAQ is the one that has the highest probability of going to get the highest number, going back to get that peak. At that point, then I would almost say that's an area where I would be completely flat and potentially look for a short, is because that would be really expanding out to where you would maybe get above a 3 standard Bollinger Band and rip up to hit a higher price of that peak. So anytime I see us violate a 3 standard deviation bar that's going up, that's the area I look for to where I think it could stall, where that peak was. And that's why I say that's like unfinished business, because on the move down, that's what the possibility to the upside was on a 3 standard deviation. So when it unwinds, that's where the possibility is for it to unwind too.
Yeah, that makes perfect sense. Yesterday was an interesting day. The NASDAQ was up. The other 3 markets were down. I think that downward pressure was mitigated simply because the NASDAQ was so strong. And I think we, as you mentioned, NASDAQ is kind of the leader right now, and that's kind of keeping everything, in a more positive upward direction.
Yeah, exactly. And one of the things that I didn't talk about today that is obviously talked a lot about right now in the industry is 0 DTE options and how that flow is. You have end of the month coming up. You've got some big strikes into the S&P here towards the end of the month. And you've got Fed meetings coming up next week. So there's a lot of that options flow that's on the outside of your like I said, your outside influences that you're not seeing on your screen, on your strategy, but they're things that are definitely influencing it. And maybe we go to the SDYE question of the week this week, Mike, because I think that was something about 0 DTEs, if I'm not mistaken.
Yes, let's take a look at that. So the question came from Penny Lane Belaine on Twitter. Is there an advantage to trading ODTE options over futures?
And so first of all, what is the 0 DTE options? It's 0 days to expiration. We have them in micros. We have them in E-mini S&P. They have them in SPX. They have them in SPY. And they are really just weekly options that expire on Monday through Friday. And so they're every day they expire. And I think that there is only a very rare and few occasions where 0 DTE to me would supersede me choosing a future. And maybe I use the options on futures in this specific instance. The one thing about a 0 DTE is that you have to be right really early on, and that move has to have velocity to it, because you're dealing with theta and all sorts of different things in the options market, where in the futures market, you don't have to deal with that. I think that you look at their 0 DTE options flow to help you with trading futures. And maybe if you really like a scenario, a 0 DTE option can be a good choice sometimes, because you have that fixed amount of risk. You buy that option in the futures, or you buy that option in the SPY, and you're just saying, look, I think we're just going to explode from here, or we're going to break from here. And you think it's going to be a high velocity move that would almost be an even more leverage than futures. I don't necessarily think that that's very smart for probably retail traders, but there are times as advanced traders will look at that and say, this might make sense here. And we're seeing more and more institutions trade those on the options on futures as well as the SPY. So it's a new kind of thing because there's so many expirations. It's not new that is that there are that many expirations for the S&P. It's just new that more and more traders are trading them. But I do think that futures are almost always going to be a better option, no pun intended, for that trade selection.
No, I totally agree. And of course, this is a fairly new product, typically designed for larger, more institutional type traders. And if you want to trade these, I don't think there's any problem with that, but you have to do your homework. Options are a more complex asset class to trade than futures. And if you are interested in these, before you start trading them, make sure you do your homework.
Yeah, absolutely. And there's if you want a true 0 DTE without that theta decay, you can go and learn about event contracts. We actually just got back from Vegas, Mike. I was doing some live stuff out there. It was great to see so many people out there in Las Vegas, and really a lot of buzz about event contracts because of the 0 DTE buzz that's going on out there. And actually an event contract is a true 0 DTE. You can learn more about that at my website at placeyourtrades.com, or of course CME Group. But I want to pull up my screen real quick here because I want to talk about an outside influence of an indicator that is extremely important to watch. And that is CME Group's FedWatch tool. You can just Google this or just go to CME Group's website and find their FedWatch tool and look at, we're now at 500 and 525 basis points. So basically it's saying that the current target rate is 475 to 500 in the Fed. We might see a rate, a quarter basis point still come in the future, which is interesting. And you can click on all these different months up here to see where we look. And, you know, if you keep going down the chain here, look at where they think we're going to be in December, lower than where we are right now. So the market is pricing in potentially cuts. And I just wanted to showcase this tool on CME Group's website, because this is where all of the macro players I know go to see what the projections are. And these aren't just things that CME Group is projecting. These are things that are actually coming from the Fed funds futures, and it's showing where people are actually putting their money on. So an outside influence of what's happening in the markets is always going to be what's going to happen with the Federal Reserve and interest rates. And to me, this is the best tool out there to be able to see what the market is projecting for Fed rate hikes, or it looks like we might see rate cuts. At least that's what the market's thinking, but who knows?
Yeah, I mean, I was a bit surprised that the percentage held today after the GDP number. I thought that would have gotten the Fed's attention, that, you know, hey, you know, they were, if you looked at the Atlanta Fed over the last couple of weeks, they were saying first quarter was 2.5. And to come back and adjust that down to what they did today, I mean, it kind of makes the point that, you know, the hikes are working a little bit. GDP is down, but that didn't change it at all. There's still a very high probability that we're going to have that rate hike next week.
Yeah, I mean, and if you look at July, they're basically saying that May we're going to move up a quarter basis point. July is going to stay the same. But keep an eye on this tool, everybody. It's extremely important, because if you start to see the probabilities go up to 525 to 550 or back to 475, 500, that is something that will have an outside influence in understanding how you should analyze the market environment, which we discussed today.
I agree. So, Anthony, it looks like we are just about out of time. Anything else you want to cover before we go?
No, everybody. I just think that, you know, once again, you know, earnings times can be a little bit tricky for the future side. These Bollinger Bands and these Fibonacci's retracements that I showed you, and just, you know, layering the VWAP. I just think that, once again, it's just a way to analyze the environment. And I look at it, and it just really helps me get a clear picture of which direction I want to be on more than another. I think you're all going to have your strategies in the short term. All I want to try and do is help you understand how to analyze the market environment. And there is no holy grail to any of this, but I think it's important, whether you use what I talked about today or anything, just to help you identify what's happening on that little bit of medium to even bigger picture, so you can become a better trader and executor of your strategy during the day. So hopefully that helped you guys today.
Well, Anthony, thanks for an outstanding presentation. I've always loved your approach. And once again, I hope we can do this again real soon.
Yeah, it was great, Mike. And I look forward to you and I doing live stuff again. That was the best.
That would be fun. You can find Anthony Crudele on Twitter and Instagram. This afternoon, we have Bars Closing. I'll be hosting Bars Closing. Tomorrow morning, Friday, we have Jim with the opening range again. And then I'll finish out the week with Bars Closing. Thanks, everybody, for joining. Thanks again, Anthony. And everybody have a great day in your trading. Thanks for joining.
See you, everybody.